countries have broken those rules. And as we've been reporting, Standard & Poor's has cut Russia's credit rating to junk, and that puts it below investment grade and makes it far harder for Russia to borrow money from investors. Tom Barton has more from Moscow.
This is the first time in a decade that Standard & Poor's has cut Russia's credit rating to junk. Finance Minister Anton Siluanov said that S&P's rating was excessively pessimistic and that it probably didn't take into account Russia's finance anti-crisis plan. The rating of BB+ puts Russia in the same category as Bulgaria and Indonesia.
The oil price decline has its whole own set of drivers, and certainly the economic sanctions. It's not just their direct effect on Russia, it's the effect they're having on trust in the business climate in Russia, which I think is really dampening and causing a withdrawal of foreign investment that Russia desperately needs if it wants to keep modernizing and diversifying its economy.
Finance Minister Siluanov says Russia's anti-crisis plan does not envisage increasing government spending or spending Russia's reserves irresponsibly. But economist Andrei Nechayev is one of those who says that the Russian government will inevitably be dragged into more spending.
Most of the experts expect a 5% drop in GDP. This is less than what we had in 2008-2009, but the situation is being worsened by Western sanctions, which makes it very different from the situation of 2008-2009. That's why a long-term debt crisis is quite likely, as well as a debt default on certain companies, which will have to be picked up by the state.
Standard & Poor's say that Russia's monetary policy flexibility has become more limited and that its growth prospects have weakened. The Russian economy is expected to contract between 4% and 5% this year, and the Russian ruble has lost more than 40% of its value against the dollar amid falling oil prices and international sanctions over Russia's actions in Ukraine. Tom Barton, CCTV, Moscow.